If I sell all my US core holding positions and put them all in HYLD, so if I sell my USCL, my HYLD, my SDAY, my QQCL, and my QDAY, and I swap it all into HHIS as my main core US position and keep the Bitcoin stuff, I'll add an additional $7,500 a month of passive income. Should I do it? Guys, this is a question I get very, very often. Should I do this? Should I do that? What's best? Should I swap into this? Something new comes out. Should I trim this and go into this? This is what I feel is actually the blessing and the curse of the do-it-yourself investor. Of course, the blessing, everyone, is that everything is under your purview. You could manage everything yourself. You don't have to deal with a financial advisor to babysit you or anything like that. You could do whatever you want, whenever you want. It's fun. You gain knowledge. You gain understanding of the stock market and everything. You could modify and do multiple strategies to make, depending on where you're at in life, according to your objectives, right? You could really customize everything. That is really the blessing of the do-it-yourself investor. The curse is that now we have so many options. Even if you selected, I'm going to be a full PII investor, let alone now you could add some growth stuff, some dividend stuff, some covered call stuff. Even if you decide, you know what, I'm just going full PII, like I am, for example, there's still many decisions to make. New funds coming out all the time. Should I swap into this, do this instead, get more yield by doing this? So today, many this is the topic I want to talk to you today about, and I came up with 7 points to maybe help you go through this in case you're like losing sleep. You're always thinking about stuff, especially for newer PII investors who are starting to build your portfolio. So hopefully you'll enjoy this video. And by the way, no, I am not selling everything to go all into the HHIS, although maybe it could be a good idea. I don't know. Maybe HHIS, that combination of 15 stocks, will beat the S&P and NASDAQ 100. It is already doing that now. It hasn't been out for a year. So it could be a good idea. But should you do it? Well, these are my points. So first of all, point number one, you have to remember that there is no right or wrong when it comes to do-it-yourself investing. There isn't the best. The best does not exist. Only the best for you exists. You have to remember that everyone is different. Everyone has a different tolerance, different investing objectives. So whenever I see questions on anywhere, what is the best? I know that you're pretty much a newer investor, and that's okay. That's fine. Remember, you got to figure out what's the best for you. And when you go on the internet and you search for what's the best what's the best dividend ETF, the best dividend stocks, you notice that you can't really get a consensus answer. There's always different opinions. Well, that's why, because the best does not exist. Point number two, very, very important. I can't stress this enough. You have to look at what you're investing in. You have to look at beyond the ETF, beyond the ticker symbol. You're not investing in HHIS. You're not investing in HYLD or USCL. You're not investing in that. That's just a middleman. That's just holds assets. What are you actually investing in? An investment in HHIS is an investment in 15 stocks. In USCL, it's the S&P 500. In QQCL, it's the NASDAQ 100. Of course, with the covered calls and 25% leverage. But the point is you got to look beyond the stock symbol. Look at what you're investing in, the assets you're investing in. Very, very important. Point number three, understand the strategy that the ETF fund manager is using. It's very, very important. How much covered calls are they doing? How much are they covering of the portfolio? Of course, I'm talking about really covered call stuff, income stuff here. How much upside are you giving up? It's very important you understand. And typically, one fund provider has the same strategy for all their covered call ETFs typically. So, and of course, I have them on my channel all the time, discuss it with them all the time. It's always the first question I ask. Every fund manager has a little bit of a different strategy. So you have to Again, know what you're investing in and what is the cover call strategy, what is the strategy of the ETF. Another point number 4, new funds. People get confused of this. A new ETF came out, HHIS came out recently, 7 months ago, 8 months ago or something like that. Hamilton just launched an amazing line of 3 0DTE funds, C Day, S Day, and Q Day. What do I do? Should I swap into this? Should I sell this? Go into this new fund right away? There's a myth that I see online all the time that never invest in a new ETF that just comes out right away, because new ETFs tend to go down at the beginning. That's complete nonsense. And just by looking at C Day, S Day, Q Day, or MSTE will kind of prove that it's complete nonsense. Guys, the ETFs don't go up and down because they're new or old. They go up and down based on the assets inside the fund, guys. If a new S&P 500 ETF comes out that just tracks the S&P 500, let's just say, and it goes down 10% in the first week, it's not because the ETF is new. It's because the S&P 500 went down 10% that week. If somebody launches an S&P 500, brand new S&P 500 ETF, and it goes up 20% in the first 2 months, well, you kind of blown your own. It's because the S&P went up 20%, right? So it just follows the assets inside. It's okay to invest in a brand new fund. I don't get the premise where I'm going to wait and see. You could wait and see. That's completely fine if you're trying to decide, should I swap into this? You could wait and see. I think it's actually a good idea to wait and see if you want to see how the fund behaves, if you don't understand the strategy. But again, I know S Day, Q Day, and C Day, for example, I know how they're going to move and react because I understand the strategy and know what's inside of them. I know how it's going to move similar to another fund because it has the same assets and the strategy is similar. A little bit more on that after. Another thing you could do, another point, play the what if game. The title of this video was, should I go sell everything to go in HHIS? Run the numbers. Play that what if game with yourself, with your wife. Have some fun. Run the numbers. And the discussion and the thought process, although it could be time consuming, you could learn. And that is, thinking about that and doing these changes in my portfolio. What would my portfolio look like? Simulate it. Run the numbers. That's how you grow as an investor. That is how you grow your knowledge, because most likely it's gonna prompt you to do some research and some thinking. This is how you mature as a DIY investor. Another cool trick I always use is, I have an Apple phone. I have the stock app watch list, and for example, I'll put similar funds that I feel are very similar next to each other, and you could look at them at the end of every business day to see how they react in terms of percentage. So for example, you could put HYLD next to VSP, look at the percentage to see the correlation, right? Or HYLD, USCL, SDAY, for example. Well, HYLD is hedged to the Canadian dollar, USCL is not hedged, and SDAY is not hedged. So a good indicator of what SDAY's behavior is, put it next to USCL and VFV, right? S&P 500 with covered calls and 25% leverage, not hedged to the Canadian dollar. The Vanguard S&P 500, not hedged to the Canadian dollar. SDAY, well, that has US dividend stocks. It does 0DT options on the S&P 500, and it's not hedged to the Canadian dollar, and it has 25% leverage. So those three are good to kind of compare. You could do QQCL versus QDay versus QQC. You see where I'm going with this? So put them in your stock app watch list, and at the end of every day, you could even take a screenshot every day and look at it for a week, 2 weeks, to learn the behavior of how these funds react or how they compare to other funds. That could give you a good hidden indication if it's right for you, if you're comfortable to do any swaps. Another thing, this is very important, is to establish benchmarks as well, right? This is kind of my previous point, establish benchmarks. So I'll give you an example. The index ones are the easiest, guys. So HYLD, I saw someone in the group compare it to YMAX the other day. I think that doesn't make any sense. HYLD should be compared to VSP or other S&P 500 covered call ETFs hedged the Canadian dollar, right? Maybe the Evolve one, ESPX.B, would be a good comparison. USCL should be always compared to VFV if you're trying to see how it performs versus the S&P. QQCL, you could compare it to QQCC to see how it is versus the non-leverage and versus ZNQ or QQC, the NASDAQ 100. Sometimes it could be a little bit harder, like HHIS, it's very hard because you don't really have a correlated benchmark, but some of them are harder than others, but some of them are easy, right? So you could, or other funds. So for example, another example would be a fund like HDIV, which is kind of like North America. It has Canada, it has the US. What are other covered call all-in-ones that have more, more diversification region-wise? You have HDIF, you have HDIV, you have BMAX, EQCL could be one of those. So maybe those you could compare to each other, right? So always have benchmark and know which fund to compare to. Total return wise here is also a tip, something I do very often to further my knowledge of how these funds behave. And which will give you more data and insight if it's right for your portfolio. That's the whole point. Last point, very important, go with your gut. Listen to your gut, your stomach. Not me. Don't listen to me. You could listen to me, and I know many people copy my portfolio, copy my moves. I would never recommend that to anyone. And I'm really humbled by the trust and everything, don't get me wrong. But you got to develop your gut and your stomach, and you will by default as a DIY investor. If you're newer, you're going to have less of a gut, less mature. You're going to have less instinct. It's only normal. It's only with time. And trust me, after a year and a half, it gets very mature, but it's only after going through your first crash, market crash, even if it's a small dip one, where you really mature and you develop your gut and you know, okay, I could stomach more volatility, less volatility, take more risk, take less risk, etc., etc. Get out of international and Europe to go more comfortable fully in the US. Put 10% Bitcoin exposure instead of 5%, right? This is all stuff that comes with time and experience, but always listen to your gut. And again, it depends on your situation at home. Are you really, really, really reliant on this income every single month? Or you have 10 years to go, it's all on drip anyway, right? So there's different circumstances. That's why when I see questions, what's the best? I just go like this. I'm like, I don't know how anyone could ask that question. You're asking advice, that's fine, but maybe phrase your question is, this is my situation, what do you think is the best for me? That's a little bit better than just saying, what's the best ETF for blah, 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 blah. Right? So if you're a do-it-yourself investor and you're starting, I would say a good thing to do is establish your core positions in terms of percentages. Stick with the diversified index-based stuff. If you're a bit newer investor with the lower risk stuff, right? To me, the safest, most boring, lowest risk thing I would ever invest in, my bottom, to me, kind of like my savings account. I don't believe in savings account or having cash. Like a place that I would always put my money and always sleep like a baby no matter what is the S&P 500. That's just me. For me, that's the boringest thing that I trust 100%. But some people, maybe you're not there yet, right? So you'll get there with time. Trust your gut. A good hint is, are you losing sleep over it? Are you worried about it? Well, maybe you have a little bit too much risk and you could adjust accordingly. So that's it, guys. The blessing and the curses of a do-it-yourself investor, portfolio management, right? It's really fun doing it. It has a lot of benefits, but there's also some curses as well. You're thinking about this and there's new funds coming out, but take your time, go slow, go easy. Trust me, you will gain knowledge and experience with time. Of course, make sure you're subscribed to this channel. If you're a PII investor, this is your number one source, so we'll get you the information. Watch the Q&As with the fund managers, the people actually managing these funds, right? If you are interested in learning more about an ETF, an income-oriented covered call ETF, go on my channel, click the little magnifying glass, search for the stock symbol, and you'll see the videos, right? I have a playlist dedicated to just the Q&As with the fund managers. That's where you'll learn Q&As with the fund managers, learning the strategy of the ETF, what's inside the ETF and going through an experience your first crash. So don't give up, guys. Stay in the market forever. That would be my number one piece of advice. And trust me, your gut will develop over time. Give me a thumbs up if you like this video, if you want to see more stuff like this where it's psychology based. And I actually have a playlist called my investing psychology or something like that, my mindset. And you could look at those videos if you like those videos. I have a bunch of other topics. So thanks for watching, guys. See you next time.